So what is up, everyone? Right, I won't waste a lot of time. I hope you all are doing well. I'll be real quick with the concepts in this particular video. Screen recording, I'll be speaking about candlesticks and patterns, basically. How do you use them, how they can increase your win rate, and the psychology behind them, and a lot. Like, if you're not aware of using the right thing at the right place, I'll clear your things about the candlesticks and the patterns that you need to use to trade, right? So let's start the video. Cool. So okay, okay, this is not the right chart. Let's move on to something else. Cool. Oh my god, what's wrong with it? Watch list, fresh chart. There we go. All right, remove this quickly. So the first candlestick that first, let's just get familiar how the candlesticks work. All right, so my candlesticks, I have a customized chart. So the green you guys must be like probably having green and red candlesticks. So we'll be using the term bullish candlestick for the green candlestick and bearish candlestick for the red candlestick. All right, so first I'll be talking about the high of a candlestick, the low of a candlestick, the opening of a candlestick, and closing of a candlestick. So right now, here you see in front of the screen, this candlestick, it is a bullish candlestick. So let me show you what's an opening of a candlestick, right? So of this bullish candlestick, this point is the opening, right? This is the opening of this candlestick. Then the closing of a candlestick, this is the closing. This is exactly where the candle closed. Now let's see what's the high of this candlestick. The high means that till the maximum level the candlestick went. So this is the high. And in this scenario, in this particular scenario, in this candlestick, we don't have a low, a good low. So this is the low and opening. The low and opening for this candlestick is cool. So okay, this is the opening of this candlestick, the opening and low of this candlestick. Then this is the high of this candlestick, and now this wick, the end of this wick, is the high of this candlestick. All right, let's see it on another candle. Right, we have the 4 points. Let me find a good candle to explain you. All right, there we go. We have a candle here. Okay, so let's move here. This is a bearish candlestick. This, you see this blue candlestick, this is the bearish candlestick. This is the low of this candlestick, right? Let's mark it. It's the low of this candlestick and the closing of this candlestick, and this is the high of this candlestick, and this is the opening of this candlestick from where this candle opened, and the closing and low of this candlestick is exactly the same, right? So what does all of this mean? So this bearish candlestick opened from here, then the sellers, the buyers stepped in, they pushed it till here, till the high, right? This candlestick opened here, then got pushed by the buyers till here, but the buyers were very weak and the sellers showed some strength, and then we just moved down till here, and then we closed. Cool. Let me show you another example, right? Yeah, so this thing right now is a bullish candle. This black candle is a bullish candle, and it opened from here. It opened from here, right? This is from where it opened, and then these sellers actually pushed it till here. You see this massive wick? The sellers pushed it till here, but they could not sustain on this level. And then the sellers came here, and then the buyers pushed it back up, and we created the low of this candlestick. And then finally we went all the way up here, right? The buyers pushed it till here, but the sellers had a little bit of strength. Then they pushed it down, and then here we have the high of this particular candlestick. All right, wait a second, right? And then now we have the finally this candlestick closed here. Now we are familiar with the opening, closing, high and low of a candlestick, and we also know what causes a candlestick to go up and down, right? Like here, the sellers tried to dominate and push this candlestick till here, but the buyers were more stronger, so they pushed it up here. And the maximum the buyers could push it till here, and then we got some sellers here. So this is finally where the candlestick closed, and this is a bullish candlestick. Now we are all familiar the opening, closing, high and low for candlestick and what causes it to make new highs and lows. Now we know how candlestick works. So now let's move on to the second part of this video, in which I'm going to explain you about some great candlestick pattern which you can use to trade on, right? So here I see something good, right? So I'm going to talk about a candlestick. Let me first mark it off. All right, let me mark it off. Cool. This particular candlestick, we'll be talking about this candlestick. Some people call it shooting star, some people call it inverted hammer, and I call it pin bar. To make it easy, I call it pin bar, and many others call it too. So as I always say that things got several names, but you just have to be familiar with the concept, and then you can just like literally call it whatever you want to call it. So let's just get through the concept. So what this candle means is that the buyers pushed it till here, but then the sellers were so strong that they made this the closing of the candlestick. And this sort of a candlestick which looks like this is known as a pin bar, and you can literally enter on this pin bar. Like after a pin bar is formed, you can enter here, keeping the stop above the high, tied to the high, and then you can like literally, if you wanted to aim for a 1 2 3 or what, right? So then this is what you see here, right? You got a good push to the downside after this candlestick, right? You got a 1 2 4 here, right? So let's see another example on the chart, right? A better example, right? So as I see another example of a pin bar, a crazy pin bar. This one's a crazy pin bar, right? Okay. So again, what happened? That sellers pushed it till here. This pin bar you see right here. Sellers pushed it till here, but buyers were so strong that they did not let them, hold it till here, and then they pushed it up. So this is a pin bar, and on this pin bar, if you made a long position here, right, stop below the low, and you might want to target this high. Maybe you get a 1 to 2.4 RR, risk to reward. But if you like exiting 90% of your trade on here, and then trailing at no cost, stop loss, then just see how much you would have made. This is crazy. This is crazy risk to reward, guys. It's like 1:8, right? So let's see another quick example. Let's first of all move on to a higher time frame, so about 40 minutes, right? Now, for example, let's see, do we have any candlestick here? Any good candlestick? Okay. Now, we learned what is a pin bar, right? Now I'm going to give you a very good, whatever you want to call it, a tip, or what people do not show on YouTube. So this particular thing is my concept, or some other people also teach it maybe. This is known as the hidden pin bar. I'm going to mark it here. This is the hidden pin bar. So you see these two candles here. These two candles, you see these? Wait. You see these two candles? This blue one, and this black one, this bearish one, and this bullish one. Now, right now you'll be thinking that it's just a regular candlestick, but let me mark this zone first. Now, as we move on to the higher time frame, right? Where did we mark that candlestick? Okay, cool. There we go. Now here, you see this is that those two candlesticks that we marked. Now on the 1 hour, like on that time frame, that was a regular candlestick, but now on 1 hour, it looks like a pin bar, and you might want to enter here, keeping your stops right below the low. You know, maybe aiming for this high, right? A 1 to 2.5 RR, and then trailing after exiting 90%, and just see how much, like, let's just see how much you would have like literally made in this sort of a trade. Let's see. Oh my goodness, this is crazy. This is absolutely crazy. This is literally the craziest trade like I see this thing, right? This is literally crazy. Oh my god. You see, 1 to almost 20 RR, bro. That's crazy. That's crazy, right? So now we have learned about the opening, closing, high and low of a candlestick. We have learned about pin bars, and we've learned about hidden pin bars. On the smaller time frame, they may not look like a pin bar, but when you move on to the higher time frame, they will look like a pin bar. And after some experience, you don't even have to move on to the higher time frame. You'll spot it on your own that it's a pin bar, right? Just seeing that hidden candlestick pattern, you don't even then need to move to the higher time frame. Now let me explain you another point, that the color of this pin bar does not matter. The color, if this pin bar right now, this is a blue pin bar according to my chart, but even if this was a black pin bar, it does not matter. The color of the body does not matter. All we're gonna see is the push from buyers or the push from sellers. That's all we gotta use. That's all we gotta see. The color does not matter at all. Now let's get to the main game. Now, where people go wrong, you'll see that, oh, some dude taught me that I need to enter on these pin bars. You might see this bearish pin bar, and this must be your stop loss, and maybe you'll be aiming a 1:3 at least, and then you get stopped out. Why did you get stopped out? Okay, we'll discuss it a bit later after showing you a few more examples, right? So I see another pin bar here. I see another pin bar on this chart. Short position, right? Short position. So suppose you entered on this pin bar, keeping this as your stop loss, aiming for 1, 2, 3, or maybe this low, right? This low right here. But then you got stopped out. Now, what I meant by this is that you are going to see pin bars everywhere, and not just pin bars. Whatever you see on YouTube, whatever strategies you're learning from different people, the candlestick patterns, the point is that you are gonna see it everywhere. But what you have to do is that you wanna see that thing at the right place. If that particular concept is not happening at a right place, then that has no value, and that's totally useless. So what I meant is that you want to see the right thing. You don't just want to see the right thing, you want to see the right thing at the right place. Understanding, guys? So let me show you a quick example. All right, let me show you a quick example. Now, for an example, right? Maybe you'll mark this particular zone as your supply zone or your resistance, right? Whatever you wanna call it, order block, bearish order block, whatever you wanna call it. Now you wanna wait for the price to come at this particular level, and then you have to see the thing. You see this pin bar. You see the wick, like how crazy buyers were, like how crazy buyers pushed it till here, but the sellers were so strong that they pushed it back here, bro. These are the market makers pushing it back here. So this, now you're seeing it at a right place. You're seeing this at a resistance level, and now this is a quality pin bar. This is not a random pin bar that you are seeing anywhere. This is a quality pin bar. Maybe you're entering here, your stops, you cannot give such a big stop loss. You maybe give a stop loss somewhere around here, right, using this supporting your trade, right? And then you aim for 1 2 3, right? Then you aim for 1 2 3. So what did we learn? That whatever concept we're using in our trading, we want to see that thing at the right place. We cannot, because the charts are like that, guys. These charts are made to confuse you, getting into wrong trades. So how you want to fix that is that you want to see right thing at the right place. It's a combination of these two things: the right thing, the right concept, the right candlestick pattern, the right entry model at the right place, at the right point of control, in the right zone, right? You cannot spot it anywhere on the charts. See a quick example. All right, let's see a quick example. Okay, let me find something. Okay. All right, let's find something cool. Okay, I see another hidden pin bar, guys. Remember what I just taught you? So now on the 1 hour time frame, you see these two candles. They look totally normal to you, but as you move to the higher time frame, maybe 3 hour, we mark that zone. Let me spot that zone real quick. Let me quickly find that zone, right? So I mean, where did we lose it? Where did we mark that? Okay, this looks a bit sus. All right. Okay, I think we lost it. That was a very good example. I think, what if it was somewhere around here? Okay, that's not there. Was it here somewhere around? Oh my goodness, I should have marked that pretty bigger than that. Alright, that's totally fine. Let's search for another hidden pin bar, right? I see. We're not gonna see for hidden pin bar on such a big time frame. Let's move back onto the H1 time frame. So oh, we marked it here. Let's increase it, the size. Now we're gonna see it for sure. I lost this. Hope to not lose. I hope I do not lose this time. Okay, so again, this is a hidden candlestick even now. Okay, on the 4 hour time frame, now you see it turning into a pin bar, right? And now you're gonna enter here, keeping your stop tight to the low, aiming for a 1 2 3 or till any high. You see, right? You're gonna keep it simple. So, and also another thing that you wanna, now as I was saying, that you wanna see it on the right place, guys. Now we are seeing this on the right place. Like you see how many times the market took support from here, one time, two time, three time. So we might mark this whole zone as a demand zone. And then we came to this level, we formed this pin bar, and then we went up. Not to the moon, but yes, we went up. So this is a very good example, guys, right? Now we've learned about the candlesticks. Now let's move. Okay, and you guys must be thinking that I just thought about pin bar, guys. I just thought about pin bar because this is the only candle that works. That works for me at least. Like there are tens of different candlesticks names, other patterns. Three black crows, three white crows, but it has never worked for me, and I'll be only discussing what has worked for me over the time. And these pin bars, they've been working over historical periods for a long time. So, they might just they might just work right for you forever. Okay. So, now let's get off the charts first. I'll get on to some drawings. Okay, now let's see some patterns. Number one, let me first quickly draw it, right? Pattern number one, pattern number two, right? Okay, this is a set. Let me quickly separate it. Now another set, right? So this thing, there you see it, and now here. Okay, now this, there you go. So now this is known as W, or a double bottom. W or a double bottom. And this is known as triple bottom. And people give it different names. People give it different names, right? I'll make it simple. Either you call this W, or you call this a double bottom, or you call this a triple bottom. Same ways, some people call this as an M. You want to call it as a double top. And same ways you can call this as a triple top, right? Now, as I explained you guys, one thing that you want to see these patterns at the right place. You want to see the right thing at the right place. So we want to see W, and you call this a triple bottom. You want to see this at a support or a demand zone or a bullish order block or whatever you want to call it. And this M, or double top or triple top, you want to see this at a resistance or supply zone or a bearish order block or whatever you want to say it. Now we have the right thing at the right place. The right thing at the right place. Now how okay, like guys, let me first tell you another tip. I'm giving you a quick tip. So you don't want to use things on random. You need to believe in them. And how do you believe in a pattern? When you know the logic behind it. So the logic behind these patterns is that, just for an example, why do these patterns form? For example, 500,000 retailers entered here, right? 500,000 retailers entered here, keeping their stops here. They entered here, keeping their stops here, and aiming for some sort of high. But then what the market makers, the big players do, they cut their stop loss to generate liquidity. And now there's a lot of liquidity in the market, and now a pattern is also formed. So you can enter somewhere around here after a confirmation and then aim for some sort of highs, right? Now this is the logic behind this, that they buyers being collected here, and then market makers cutting their stop loss to generate liquidity. Now again, how it is the same with the triple bottom, right? Now here buyers came in here, right? Buyers stepped in here, who don't use patterns and all that. So buyers stepped in here, and then the market came here, and the market like cut their stop losses again. And now, maybe few now after making this move, now people will think that it's a W. Let me enter here, right? They will FOMO into this trade, and then they get stopped out again by the market makers. And then we have a triple bottom, and now maybe you can enter after some sort of confirmation, keeping your stops here, aiming for some sort of highs, right? So this is the logic that we are making this for trapping buyers and sellers both. The market makers are like, we are retesting that level again and again, and the logic, the psychological belief is that this is just happening to generate liquidity, and every big move you see, that only happens when there is enough liquidity in the market. If there's no liquidity, no stop losses are hunted in the market, there is no big move going to happen. And now the liquidity concept that I explained you here works exactly same here and here, right? The thing these market makers did with buyers, they do the same thing with the sellers this time. Now let's plot this in the charts, right? Okay, let's see. Okay, let's move on to the charts. Cool. Okay. Let me find some good example. We need to move a bit lower. 1 hour. Let's go here. Okay, so specifically talking about it, just for an instance, right? Okay. Let's find. I'm finding a better example. The best example to make you guys understand it the right way. Alright. Now, cool, I found it. So, okay, but it hits your stop loss. Fine, I'll still explain it because it's a good example, right? Okay, so you might mark this as your demand zone. A demand zone is here, and then a demand zone is at this level. Demand zone or support or whatever you want to call that, right? It's extended. Now, this demand zone got breached. We're going to remove it. Now it came here. The price came here, right? So it formed a double bottom or W, exactly like this. So now, if you use W's, you can sort of, maybe after seeing the market structure shift on a lower time frame, you can enter here, keeping your stops below, this low, aiming for 1 to 2 or this high. Although you got stopped out, but this is how this pattern works. Also, there's no strategy with 100% accuracy, right? You're gonna get stopped out, but this pattern was a very good example. And this pattern, like if I get to trade this pattern, I'm gonna trade it 10 of 10 times, right? Now let's see another example. Now the right thing at the right place, as I explained you guys, right? Okay, I see something cool. I found it. You might mark this as your supply zone, order block, whatever you wanna call that. Now, this zone, you see the market making a triple top. Oh, it's the wrong. Okay. You see the market forming a triple top, just as in the example I told you, right? This is what the market is forming. Now, the liquidity concept works the same. Here also, as I explained you in the drawing, maybe some sellers entered, okay, wrong one. Maybe some sellers entered somewhere around here, keeping their stops, after this candle. Entered here, aiming this, and then the market maker stops, they get stopped out because of the market makers to generate the liquidity in the market, right? Now again, you see maybe some sellers came on this particular level, right? On this particular level, aiming for this low, putting your stop somewhere anywhere around this, and then they get stopped out again. And then we were patient. We were not FOMOing like these people, because we know the concept that I've taught, that whenever and everyone teaches this, whenever the market is sideways, you wanna stay careful, right? So even if we entered seeing a double top, like suppose we just saw this M and we don't want to wait for the triple top, if we enter here, we already know that the market is currently sideways, and sideways means that the market wants to generate liquidity. It wants to cut stop losses. So if we are entering here, we are going to put stop loss above this high, so that even if the market goes against us, we don't get stopped out like other retail traders. And when the market came here, we did not get stopped out. We gave it a bigger stop loss and a bigger take profit to maintain our risk to reward, and we got our TP with a good 1 2 3 1:3 risk to reward. Great. So this is the exact thing. So in this particular video, we learned about pin bars, the opening, closing, lows and high of a candle, the hidden pin bars, a little bit about liquidities, double top, triple top, double bottom, triple bottom, patterns. And the most important thing that we learned here is that we want to use the right thing at the right place, because you're going to see these things everywhere, bro. You see here, bro. You see a double bottom, you see a double top being formed here, right? You see a double top being formed here, but this is not the right place. I don't see any sort of support, any sort of resistance or supply zone or bearish order block here. Cool. So that's it for this session, guys. All right. Hope you got a lot to learn, and that's it, right? See you next time. See you the next session. Bye, guys.